Today I'm going to take you into a deep dive into the fundamentals of this company, this old boomer of a company. I'm going to use historical data to make my assumptions about the future, which will help me determine what price I should be paying, applying a nice margin of safety. And then I'm talking about why I got Intel on a very, very tight watch list right now, looking to buy it. This is a prime example of what we as value investors call overpaying for growth. If I told you in year 2000 that Intel was going to decline 30% the next 22 years, I think you would have said, Olliver, you are probably crazy. This is just a prime example because their revenue has just tripled since then, and their profitability has tripled, and all the metrics, all the fundamentals of the company has just tripled, quadrupled. They've come such a long way since then, but still their stock price is down since then. So today I want to really go into depth on this company and see if it's undervalued or overvalued, what I'm doing in regards to Intel. So Intel has a market cap of 200 billion. Thing that we have to think about when we are dealing with large cap stocks, what is reasonable to forecast of their future growth, right? Because if we predict that they're going to triple, double, quadruple, something like that, right? The market cap has to do the same thing. And that means, well, when are we looking at like a $6 trillion business like Apple, if it has to double, right? That just certain things, it's just much easier to double a smaller business than a bigger company like this one. We have a PE of 10.5, their market cap divided by their earnings, and we have a price to sales, which is their market cap divided by their revenue, that is 2.5. And we have a free cash flow of 10 billion the past year. Over the past 5 years, it has been an average free cash flow of 14.5 billion. And they pay out a nice 2.5% dividends, which is 5.5 billion. So they basically have like, they use a little bit over a third of their 5-year free cash flow. The past year, they've done a little bit worse than their average in regards to their cash flow. They are investing heavily into the business. Guys, the company can do 5 things with their cash flow. 1, they can reinvest back into the business, which that is what Intel are doing. They're building like $20 billion factory or something like that. So that's what they're doing. They can pay down debt. They can make acquisitions by other smaller companies. They can buy back shares, increasing your stake in the company as a shareholder, and they can pay out dividends. And they are paying out, it's actually a pretty high dividends, but still it's not a huge percentage of their 5-year free cash flow that they're using. So they can easily afford this dividends that they're paying. Return on invested capital over the past 5 years. This is the return that they will generate on the money that you provide. We want them to be able to generate a nice return on the money that we invest into the business. And they generate an average 10.8% return on that money over the past 5 years. They have done that. The past year that has been a little bit lower, 7.2%. Let's look at the income statement here. So the revenue, we want to see that growing over the past 5 years. We went from 62 billion to 79 billion. So check mark there. Pretty nice growth there. We want to see their shares outstanding either decreasing or staying the same. Guys, if a company has 10 outstanding shares and you own 1 of them, then you own 10% of the business. But if they buy back 2 of those shares, you still own your 1 share, but that is now 12.5% of the business. Not 10%, but 12.5%. So they've just increased your stake in the business without you having to do anything. So we want to see this number of outstanding shares decreasing. Went from 4.7 billion to 4.06 billion. Check mark. We want to see their balance sheet nice and beautiful and clean. They have $28.4 billion in cash, 110 billion in long-term assets, and they have long-term liabilities of 45 billion. And they could, so they are in a good long-term financial position. We want to see their free cash flow increasing. Well, we have 10.3 billion and to 9.6x. Why is this? Well, they have had some great years, but if you look in their capital expenditures, last year they had $20 billion in capital expenditures. Last year it was only 14. They just spent billions of dollars on basically infrastructure. So this number would have been much higher, probably also over this number, if they hadn't went out and invested in these huge factories, which will begin to pay off you know, in a couple of years when they can operate at full scale. That is of course an investment, so I wouldn't say that is really that big of a deal. We can see that there are value indicators here. This one here, the PE ratio and the price to free cash flow, both are checked, which means that is a check for like basic valuation when we are looking at that. And they are generating a nice return on their invested capital, greater than 9. Their revenue is growing, their net income is growing, they're decreasing the amount of outstanding shares by actually a whole bunch. They're in a good long-term financial position here. We can see that by taking their long-term liabilities and dividing it by their 5-year free cash flow. We want to see that less than 5, it is 3. The free cash flow over the past 5 years has decreased. They are making massive investments, so we can't really blame them too hard for this one. Their 5-year price to free cash flow is less than 20. All these just look incredible. So now it's getting really exciting for me to go in here to the stock analyzer tool, because here we can do 10 years of analysis, low, mid and high assumptions. I'm going to put them in here and base them off of their historical performance, 4 and 5. And for the PE, I'm going to go 13, 15 and 17. Because this is not even, like, we looked at Apple in last video, right? And what, they're like a $3 trillion company, and they have like a 29 price to earnings. So that is reasonable. The reason that I put in my desired annual return here at 12.5 is because this, over the past century, the S&P 500 has generated an average annual return of 10.5%. So we want to provide a nice margin of safety. We also want this to be like worth our while to go out and make riskier investments, investing in individual stocks, and also it's of course more work to invest in individual stocks. So we want it actually to be worth our while. Hit the analyze button. We're looking at like a $70 high and a $60 mid and a like $45 low. So yeah, when it hit its 52-week low here, there it was probably like all green for these assumptions. But I think it's safe to say that we can probably put in some higher revenue growth numbers here. But yeah, so basically what this means, guys, if you believe in any of these 3 categories here of my assumptions that I put in, if let's say you believe in the mid here, you should be paying somewhere between these two, I would say like $55 if you believe in the mid results, right? And that is taking into account that you want an annualized return of 12.5%. But I also think, let's say inflation, like it has been an average, like over the past century, I think it's been an average like 3.5. Are these bullish estimates? Well, you can say so, but just take into account that this year we have had like 8% inflation. So basically they have not grown. If they just increase their prices, you know, so I think here we don't like want to mimic what they've been doing because of the inflation. We have to add that to our assumptions. Yeah, there are competition coming up to Intel, but I think they have great deals with B2B clients, and I think they're going nowhere. They're producing these amazing. I know some folks that know a lot more than me about computers and chips, and they say that Intel just produces the best quality. Actually, a couple weeks ago, I took apart an old computer and just saw Intel all over the place. This computer right here is Intel. Probably some Intel in this phone, and Intel in Intel in everything these days. So so they have completely dominated the market for the like past 20 years, but now other players are starting to come in here, AMD and other companies. But AMD, I mean, AMD is just far out with their value. So yeah, that was Intel. I hope you enjoyed this video. What I'm doing here is I am putting this on a tight watch list, and I might even go ahead and buy some. If it has a bad day, couple % down, I'm gonna buy the stock. Swear to God, man, gotta buy the stock. So that is what I'm doing in regards to Intel. I think I might as well just add it to my watch list here. If it goes down to $46, I want to get notified. So then you can see right here, then it's right there. Nice. If you enjoyed this video, make sure that you like and subscribe. I'll see you in the next video. Have a great rest of your day. Brah.